Some of the banks that you've sold include USB, Wells Fargo, Goldman Sachs, JP Morgan, PNC. Should we think that they're banks that aren't well run because you've sold them? Or?
No,
okay.
no. But I do think banking can get in a lot of trouble just because of the kind of things that they did, and that I didn't like the banking business as well as I did before.
We have had lots of investors in commercial real estate who have come in and said that this is going to be a crisis point, that the government is going to have to step in, that something should be done because there are so many commercial real estate loans that are coming due between now and 2025, and that they won't be able to get credit from the banks in the same way to renew or to, once those maturities come due, to refinance.
Well, let's say they lose $100 billion in the banking system. Most of the banks can take that loss, their share of that loss, and a few of them, because they did other things, their shareholders will end up losing the money, but the depositors won't lose money. But banks can take a lot of loan losses, but they can't take something that wipes out their capital and expect the world to ignore that fact. I just think the system isn't set up quite right in terms of connecting punishment to culprits on something that's it's incredibly important that your banking system run well in the country. It just isn't going to work unless you have a banking system that works, and you don't want them to create periodic crises unnecessarily.
You say occasionally they do dumb things. Maybe you're talking about Wells Fargo with the scandal that it had. It just settled on Friday with a number of the regulatory institutions that were kind of looking into it, the investigations that were taking place for $3 billion.
Yeah.
Does this mean that they have kind of finally gotten through that and can move forward?
I don't know the answer to that. I know that they paid $3 billion because it was announced. I don't know what else is outstanding. But Wells Fargo is classic in terms of one lesson. My partner, Charlie Munger, he says, whenever we have a problem, you attack it immediately. He says an ounce of prevention is not worth a pound of cure. An ounce of prevention is worth a ton of cure. And we've seen that time after time. And the original thing was a whole bunch of phony accounts. Now, I don't know how, if you open up a couple million phony accounts, you make any money on it at all. I mean, the shareholders didn't make money. People say that,
the incentive structure was set up so that some of the employees didn't make money. It was the dumbest incentive system you can think. And as soon as you learn, you can devise dumb incentive systems. We've done them ourselves. I mean, you can cause people to do the wrong thing because they will do what they're incented to do. And they had obviously a very dumb incentive system. People started playing it in various ways. And the big thing is they ignored it when they found out about it. I mean, you're going to do dumb things in business, and we do them every day, But you absolutely have to attack a problem as soon as it occurs, and you know about it. And if that had happened, Wells Fargo shareholders would be a lot better off. But Wells Fargo shareholders did not profit from opening up accounts that were phony accounts that had nothing in them. I mean, somebody was getting paid so much per account. And the practice spread, because bad practices do spread if they're allowed to spread. And they were ignored, which is a total disaster. And look at the consequences. So 2 or 3 years later, who's paying? The shareholders are paying for something that didn't do them any good whatsoever.